We're honored today to be joined by Howard Marks. Howard is the co-founder and co-chairman of Oaktree Capital Management, where he's helped shape the firm's investment philosophy and long-term direction since its founding in 1995. Before Oaktree, he spent more than 2 decades at Citicorp and TCW Group, working across equity research, high-yield distressed debt, and convertible securities. Beyond investing, Howard has served in advisory and trustee roles within institutions including the Metropolitan Museum of Art, the Royal Drawing School in London, and the University of Pennsylvania. He holds degrees from Wharton and the University of Chicago Booth School, and is widely known for his writing on investment, risk, and judgment. Howard, thank you so much for joining us today. I'm going to get straight into the questions. So just to start with, I'd be curious to sort of know what's been on your mind intellectually recently and what's got your attention. So what have you really been reading or thinking about around this time?
Well, let's say a week ago, I published a memo on AI and whether it's a bubble, and that commanded a lot of my time over the last few weeks. I wrote it in a 10-day period around the Thanksgiving holiday. That's how I like to spend my holidays, writing memos. And the ideas emerged from a trip I made for the prior 3+ weeks to Asia and the Middle East, where that topic was on a lot of people's minds. And so I've been engaged in that. And, I'm not a technology person, so it required a lot of coming up the learning curve, which I was very happy to do. And I feel I learned a lot in the process.
Okay, very nice. I read that memo actually, and we have a question or two about that, so I'm interested to go into that. I'm gonna go a little deeper now. So you've always described processes or investing as a process that requires being unemotional. But the way I view it is courage requires, or being contrarian requires courage, which is ultimately going against something that you see. Um, being patient requires having an impulse and acting against it anyways. And it is what it is. One of your memos, you describe the concept of mujo, uh, and in that you're looking at acceptance. Acceptance to me, again, it's not emotional absence, but emotional resolution. So I'm curious, when you sort of talk about unemotionalness, what are you really pointing to in practice?
Well, what I'm talking to, Ariane, is that you must not be captive of your emotions. Now you have to, you're alive, so hopefully you'll have emotions, and hopefully you can harness them to behave in a positive way. But our emotions conspire to make us do the wrong thing. If allowed to be unconstrained, our emotions tend to get us more excited when things go well, and more depressed when things go poorly. When things go well and the economy is growing and corporations are reporting rising earnings, and asset prices are rising, the rising enthusiasm would have you buy more at higher prices than at low ones.
Mhm.
That's not the right thing to do. And when the economy is contracting or doing poorly, and companies are not hitting their numbers, and asset prices are falling, people get depressed, and our emotion would tend to make us sell
Mhm.
as prices fall. Well, that's the exact opposite of what you should do. My mother said, buy low, sell high. Your emotions would make you buy high, sell low.
Mhm.
So clearly, you cannot let your emotions be in control, and you have to control them. So, as you say, you have to be patient. Well, patience is not exactly an emotion, but you have to have courage when it's difficult. Courage, maybe you would say, is an emotion, but it's really we talk about contrarianism and countercyclicality. I think the key is counter emotionality, and not uh, not letting your emotions control you. In 1998, we had the meltdown of long-term capital management. We had uh, a Russian ruble incident. We had a Southeast Asian crisis, and it was really a rocky time. And one of our portfolio managers came to me and said, this is it. I think it's over. I think we're melting down. The whole financial system. I said, well, explain your concerns. He did. I said, okay, I understand your concerns. Now go back to your desk and do your job. And I said to him, a battlefield hero isn't someone who's unafraid. It's somebody who's afraid and does it anyway. And you should not expect to not feel these emotional impulses. You just can't let them be in charge.
So is it stoicism then that you suggest you should have when it comes to investing?
Uh, I think stoicism is a good thing. Uh, yes, but I mean, but so resolve, which I guess is related to stoicism. Yes.
In a similar line, continuing discussion on the memo, in It Is What It Is, you also discuss the essence of investing. It's a process where you recognize, accept, and cope and respond. I think through your memos and your investment decisions, we've sort of seen the recognition, even the acceptance, and even the response phase. But in terms of coping, when you have a view on something and you have a reason to not act for a certain period of time, what does that period of coping sort of take of you internally?
Let me follow you. You say you have a reason not to act. You say,
Sure, you have a belief, but as you know, timing is not right for you to act on that belief, and you have to cope sort of with that time and that waiting of having that belief and that
oh,
idea, and then not acting on it right now. You have to be patient with it.
well, no. See, I differ. I differ from you there
Mhm.
because if you have a belief, I think you should act on it.
Okay.
I don't. I've never understood the mentality. When I was, let's say, 50 years ago, 50 years ago, I was director of research at Citibank, and I would get memos, and they would say, "Well, I like this for the short run, but not the long run, or I like this for the long run, but not the short run." How the hell, if you think that X, Y, Z will happen,
Mhm.
how do you conclude it will happen now, but not later, or later, but not now? You can't time these things. I always say that we sometimes have a rough idea what's going to happen, but we never know when. So if you have an idea, you act today. You don't sit on it.
Mhm.
Uh, and then if it progresses, if it becomes more compelling or more important, then you do more of it. But but I think first of all, in what you said about that memo, except what was your phrase?
It was
Except
it was recognize, accept, cope, and
yeah,
respond.
yeah. It was in. I said that in response to a specific thing.
Mhm.
I didn't say that as a general statement.
Right.
I said in response to change.
Mhm.
And Mujo, the Japanese aesthetic or philosophical term, is uh, well, literally translated, it means the turning of the wheel of the law. But what it means in real terms is the change is inevitable. And that's what I'm saying. You have to accept change and understand it and recognize it and cope with it. The main reason being we can't prevent it or alter it. It is what it is. That's where the title of the memo came from.
Right.
And and the one thing, I mean, I think it's very important for investors to just kind of interiorize the idea. The one thing we can't do is we can't say, you know, I think it was Oliver Twist. Dickens said, hey, he would say, "Please, sir, I'd like some more." What we can't do as investors, we can't say, "Please, sir, I'd like a different environment." The environment is what it is, and this is the one we have to cope with, and um, and we can't say, "I wish stock prices were lower. I wish uh, yield spreads on credit were wider." They're not. Stop even thinking about that. What do you do in today's circumstances? And acceptance of change, and accept, by the way, that change is always going to happen, and always be unpredictable. And this is the mindset, in my opinion, for maybe this is related to your concept of stoicism. But I think this is the mindset you have to have. This is what I'm faced with today, and I don't know what I'm going to be faced with tomorrow. So what do you do today?
That's what you have in the moment, right? You can't wait for tomorrow and then not act in today's with what you have today. Yeah, no, I again really agree with that.
Good.
Sort of continuing that idea of change. This actually turns 15 today, so in all that glitters, you take a clear position on gold. Where in my reading, the issue for you isn't whether others are right or others are wrong. It's whether gold as an asset fits within your own discipline, namely with cash flows. And I want to sort of again look at change and rigidity as a concept. So over a long career, when markets and narratives at times can sort of go against your beliefs and your disciplines, how do you sort of make sure that your own beliefs don't sort of become too rigid, but they also can accept that change?
Well, you've identified one of the great dilemmas in investing, but also a great dilemma in life. You have to have a model, a way of thinking. If you don't have a belief system and a method for thinking, then how are you going to live your life? You're going to start every decision every day from ground zero. You're going to say, well, today's a spring day. It's 55 degrees outside. What am I going to wear? You're going to sit there on your bed and think of what you're going to wear, I have to go today from New York to Boston. Am I going to drive? I'm going to fly, take the train. If I'm going to drive, which route? You have to have certain things that you believe in, and so if you don't have a mental framework, then you're just we used to use the frame will o' the wisp. I don't know if people ever say that anymore, but you're just blowing in the wind. And but on the other hand, if you're rigid, you can never change, you can never adapt, you can never learn new things. So that's not a good idea either. And that's therein the dilemma. But all of life is a dilemma. And guideposts, but not rigidity. So belief systems with flexibility. But there have to be some things you believe in at the bedrock. I call that creed, and a great example is if you're an investor, you have to have, I think, it's a foundation of value. And if you're a value investor with a small v, not capital V, not with a strict definition to follow, but if you're a value investor, that means you think about what something's worth in intrinsic terms, not just who'll buy it tomorrow, whether it'll go up tomorrow, will there be a story about it tomorrow, will there be good news tomorrow? What is it worth in intrinsic terms? What will you pay for it? And you get to gold as an example of asset class with no ability to produce cash flow. How do you figure out what an ounce of gold is worth? I'd like to see somebody show me an analytically derived price for gold a year from now. What you base it on? The only thing that supports gold, in my opinion, is public opinion. And the way I think of the conversation going, Arjen, is why do you like gold? I like gold because it's a store of value. What makes you say it's a store of value? It always has served as a store of value. Why does it serve as a store of value? Because it always has. That's too circular. There's no intrinsic bedrock in that statement. And Uh, but tell me analytically, what is it about gold that makes it a store of value? And the answer is, well, it always has been, or people value it. Yes, but how do they value it? What's the process? What is the intrinsic value of an ounce of gold? There's no number, in my opinion. And the way I explain this to people is, if I own an office building and it throws off a profit every year of $1 million, I want to sell it. Maybe you're in the market to buy it. Mm-hmm. We can have a discussion about the fair price. You can say, I'll pay you $8 million because I want a 12% return. I can say, no, you have to pay 12 million because 8% is an adequate return for an asset that's safe, that's dependable. You can say, no, 8% is not a high enough return for me. And I can say, well, but if you buy it, you can raise the rents. So it's not only giving you an 8% return, but it has upside. So we can have a spirited discussion about the fair price. I'd like to hear a discussion like that about gold. What makes gold worth 4,000 an ounce? And if you think that next year it's going to be 4,500, why? And you can't do that. And that goes, in my opinion, for all assets that don't have cash flow. And they include furs, diamonds, paintings, oil. What's the intrinsic value of a barrel of oil? And the answer is, it has a certain value as an input to production. But you can't. But that is very attenuated, and I don't think that's how oil's priced. It's priced on supply and demand. But demand is there's a lot of let me say this. As I recall, in July of 2007, oil was 147 a barrel. And you would say to somebody, well, why is it 147? And a lot of people said it was going to 200. Well, why is it 147 and why is it going to 200? Well, they're not making any more oil. Oil was the product of a million-year process. We don't add to the supply every day. And, a lot of the supply is in the hands of people who are hostile to the United States. And we're consuming it faster than it's being created. And so, it's worth 147, going to 200. Well, in 6 months later, as I recall, it was 35. And if you said, well, what makes it 35? They give you the same answers. So you can't turn limited supply, using it faster than it's being created, supply in hostile hands. How do you turn that into a price? How do you say, well, let me think, turn the crank on your machine? You say, well, 147. And so forth. So the answer is only cash flow assets are capable of being valued analytically, in my opinion.
No, that's a very interesting discussion of, I personally have always had a similar viewpoint. You can have extrinsic factors.
Well, then you must be right. If you agree with me, you must be right.
I guess within this framework, yes. I think within your specific framework, it does make a lot of sense. You're an admirer of art, right? Art is also an asset that can be sold and traded. So how would you price art? How do you personally price art if you're buying some?
Well, I think what most of us, first of all, in my opinion, the first question is, do I like it? Do I want to live with it? Do I want to wake up in the morning and look at it? Yeah. So I wouldn't buy a painting I don't like because it's kind of worth twice what I could buy it for, or because I think it's going to double. Mm-hmm. I would never buy a painting I don't like. But if you say I like it, I want to live with it, then of course one question is how much do you want to live with it?
Right.
What is that worth to you? But then the other question is, if you're me, you say, well, what have other paintings like this from that artist sold for? Now you're just talking about public opinion. Again, that's not an intrinsic. There's nothing intrinsic in the painting. So Picasso, uh, I'll give you a great example. There was a painting that I liked, and it came up for sale, and it was $5 million. I've never talked about this before, but maybe it's relevant here. $5 million, and I didn't buy it. A year later, a very, very good contemporary, meaning of the same time, copy of that painting came up, and it was $10,000, and I bought it. And so I get as much pleasure looking at the $10,000 copy as I would have gotten from the $5 million original. So why would you pay $4,990,000 more to get the original than the copy? That's an interesting question. I haven't talked about it. I've written about it. Excuse me. Maybe I'll write a memo about this sometime. But um, am I? Is there something wrong with me that I would get as much pleasure from the $10,000 copy as the $5 million real thing? Or is there something wrong with the people who would pay $5 million for the real thing when they can have a $10,000 copy? And if what makes the original worth $4,990,000 more, given that they both look the same? And believe me, they both look the same. And is it ego? Is it investment? And if it's investment, then what about it makes that a good investment? So this is a very interesting field for exploration. But fads and fancies are very important in the art world, and artwork rises and also actually falls. And there's a story of two famous art collectors, brother and sister, who were active, I believe 100 years ago, roughly, and they collected together, but then they diverged in opinion and split the collection and went their separate ways. And I think the brother sold his Renoirs and Monets to buy some artists, and maybe Picasso's, to buy some artists who turned out to be not respected 100 years later. So you can err in this, and there's no guideline, because he I don't know if he did it because he liked the ones he bought better than the ones he sold, or because he thought they'd go up more. But probably the former. Probably it was just preference. But the point is, you can get that wrong, and there's nothing to tie your hat to, certainly in the art world, other than public opinion. But it's changeable, and artists come into favor and go out of favor, and I've seen it plenty. So don't kid yourself. The idea of investing in art, in my opinion, is those words are practically oxymoron.
Very interesting. I think you have to be willing to live with it to sort of sell a Monet or Picasso and buy something that is perhaps not respectable. Still looks great on the wall, but you still have to live with
Yeah,
it. So
right.
yeah, that's very interesting. Could the same not apply to gold? I'm just thinking out loud, but gold. So I'm originally Indian, and my grandma, for her, gold is viewed as the best asset. It's something that was passed down to her by her mother. She's probably going
Yeah,
to pass it down to her granddaughters. Couldn't you see
yeah,
from
but
a sense of
yeah, but that doesn't tell you what a fair price is.
right,
You know, and if you got a piece of gold jewelry from your mother,
right,
and somebody says, that's a great thing. I'll buy you. I'll pay you $1,000 for it. You say, no, no, it's an heirloom. I would never sell it for that
yeah,
much. Then if they say, well, I'll pay you 5,000. You
mhm,
say, no, no, my family heritage is more important. Then they say, I'll pay you 20,000. They say, no, no, I want to hold this and give it to my kid. Then they say, I'll pay you $1 million. Uh, you know, uh, is there a price at which you would sell it? You're holding it for non-economic reasons, but is there a price when the economic reasons overcome your non-economic reasons? And some people in the art world think there is, and some think there isn't.
yeah. Very fascinating. I'd love to read more about this in a memo. Um, Another memo, something of value, one I really love. What stands out to me is that there's no disagreement just for the sake of it, but there are two different lenses on investing, two different eras of
Mm-hmm.
investing, and within that memo, I think both these eras are able to sit really well, very cohesively. So you and your son, for the viewers who are not familiar, you and your son Andrew came up with it. Obviously coming from different market environments, different ways looking at investing. At those, I guess, at this stage of your career, how do ideas from a different lens, completely different way of looking at investing, sort of enter your thinking, and how do you sort of deal with them? Do you accept them? Do you have a tendency to sort of incorporate them within your own investment philosophies at Oaktree and yourself?
Well, again, I think you have to have core beliefs, but I think it's important if you want to keep relevant and growing and relating constructively to your environment. Uh, I think you have to evolve,
Mhm.
and so the prior to, let's say, 1960, there was there was an activity and it was called investing. People bought stocks and bonds for whatever reasons they did. Then, as I recall, in the early 60s, and I remember seeing the first pamphlet on this subject in the, no, not early 60s. This would have been around 67. Oh, 67, 68. I remember seeing a pamphlet on something called growth stocks. And these were stocks that were expected to grow faster than the general growth rate of the economy because of technological or consumer excellence. Xerox, IBM, Kodak, Polaroid, Merck, Lilly, Hewlett Packard, PerkinElmer, Texas Instruments, Coca-Cola, Procter and Gamble, etc. So that became very popular, and growth stock investing led to a craze that was called the Nifty 50, and that craze was ascendant when I joined the industry in 1969. And Citibank, where I worked, was a devotee of the Nifty 50. And if you bought those stocks the day I got to work and you held them tenaciously for the next 5 years, you lost almost all your money because they were terribly overpriced. And some of them crapped out. But anyway, if so and so invented something called growth stock investing, then you had to have a way to describe the other thing. And so that came to be known as value stock investing. And value investing, as I perceive it, means we don't invest based on dreams about what the earnings might be in 20 years or in the possibilities for technological progress. We invest based on current asset values and current cash flows, and we only pay low price earnings multiples, low valuation multiples for the things we buy. I think that's a definition of value. Andrew argued, by the way, that memo, Something of Value, grew out of the fact that he and his family moved in with us during the pandemic. And I thought it was of great value that three generations got to live together in that crazy environment. But, his point was that's too narrow. What I described as value investing was too narrow. And that's value investing with a capital V, a school of thought. He said, what about just value with a small v? And he takes the Buffett approach that when you invest in a stock, for example, you should think you're buying not a piece of paper that's tradable, but a piece of a company. And if you were going to buy a company, hopefully you would buy it because it has earning power. And so he says value investing really means buying a piece of a company based on its earning power. And it's clearly easier to ascertain earning power based on today's P&L or next year's P&L, as opposed to the P&L 20 years out for a high-tech company. And that's where a lot of the question comes in. But, to me, that was a really good addition to my way of thinking, to not say, well, we only consider this year's financials or next year's, and we only pay low PEs. That's a little constricting. You may not remember the 90s too well, but the 90s were the hottest period, I think, in history for stocks. The S&P 500 rose 20% a year, and I think that anything related to tech did considerably better. So 20% a year for 10 years is a huge accomplishment. And there was an investor called Bill Miller, and Miller was very famous because he beat the S&P 15 years in a row. Really hard to beat the S&P 15 years ago. That means you beat it in up years and you beat it in down years, and that takes real ability. It's easy to beat the market in the up years if you're aggressive, or in the down years if you're defensive. By nature, it's hard to do both. And he did 15 years in a row. And in 99, he beat it again. And 99 was one of the greatest years. And part of it was because he owned, I'm going to say Apple. May not have been Apple, but I'm going to say it was Apple. But some high-tech company. But he was known to be a value investor. So I ran into him. And I said, how does a value investor like you rationalize owning Apple, if that's what it was? He says, well, it looked like good value to me. So you see, what he was embracing Andrew's approach rather than the strict value, capital V value mantra of slow growth, current financials, low PE. And I think that adding that degree of flexibility to one's thinking is a good example of how one should evolve. We've touched a couple of times in this conversation on something very important. How do you stick to a set of core beliefs, and how do you remain flexible enough for your thinking to evolve?
Again, looking at another concept, luck. So I'm aware you play backgammon. You've played a lot with especially Bruce and Andrew. I'm a huge player myself. I love playing backgammon. And one thing that's always stood up about the game to me is that luck's gonna happen. Like whatever happens, it's out of your control. But it's sort of how you use that luck. You can't foresee your dice, 5 moves from now. I think same is for markets. So what role does luck sort of play in how you view investing, and how has your understanding of it changed over your career?
Well, luck just means, let me think for a minute. Elroy Dimson, who was a professor at the London Business School, is famous with me, maybe with others, for having said, risk means more things can happen than will happen. I think that's a brilliant statement. If in each regard, economic growth, stock market performance, weather, cricket score, whatever it is, if in each regard only one thing could happen, there would be no risk. But there is, because the future is indeterminate. Why is the future indeterminate? Because there's randomness present in the world. I mentioned weather on my list. The weatherman will tell you what he thinks the weather will be in 3 days, but I'm sure he wouldn't bet his life on it, because it's only determinable to a degree. I mean, if I say, what's the weather going to be? Today's Wednesday. If I say to you, what's the weather going to be on Saturday? Here we are in mid-December. I would bet pretty heavily that it's not going to be 80 degrees. But I can't tell you whether it's going to be 20 or 30. And I wouldn't bet, in fact, maybe the right answer is the weather on Saturday is likely to be the same as today. And the answer is, would you bet your life on it? The answer is no, because it's indeterminate. And one of the things that makes it indeterminate is luck. How will the currents, the Gulf currents change, et cetera. And so risk is kind of like another word for luck, in a way. Now, there are a lot of things that contribute to risk that are not random. And I guess a good synonym for luck is randomness, things that will happen based on an unpredictable causality. But we have to accept that there are a lot of things in the world that are unpredictable, and where the outcomes will, among other things, be determined by luck. They also may be determined by not luck, but the fact that there is that information as to what will happen may be hidden. You drill an oil well, and will you hit oil? Well, you don't know for sure. And I think the techniques have gotten better. But so the question of whether you're going to hit oil is not determined by randomness. In other words, it's not like you're going to drill down 300 feet and maybe chance will put oil there or maybe not. The oil's either there or not. There's no randomness involved. The question is, you may make a good or a bad decision. But still, I think luck is very important. Unpredictability and randomness, and Nassim Nicholas Taleb wrote a book by Fooled by Randomness, which bears on this, very important. So I think that randomness or luck and risk are highly interrelated, not synonymous, but interrelated. And so as an investor, I talked much earlier about the importance of core beliefs. And I think one of your core beliefs should be the extent to which you think things are predictable. Some people, I think they're predictable and will bet on those predictions. And some people think they're not predictable, and obviously, by definition, will not bet on predictions, like me. But a lot of people will tell you what the economy is going to do next year. what currencies are going to do, what commodity prices are going to do, what interest rates are going to do, and they're willing to bet on that basis. Disavowal of macro forecasts is one of the bedrock elements in Oaktree's 6-tenet investment philosophy. So, but the future is going to be heavily influenced by luck. And yet you're going to make investments committing money on the basis of what you think the future holds. We all do that. I mean, that's what investing is. Investing is positioning your capital for future events. So you have to have some idea of what the future holds. And luck will determine what it actually unfolds as. And the question is, to what extent do you allow for that in your methodology? And, you know, one of the great quotes that I use a lot is from Mark Twain, the American writer, who said, it ain't what you know for certain. It ain't what you don't know that gets you into trouble. It's what you know for certain that just ain't true. So the question is, given that the future is variable, in part because of randomness or luck, how heavily will you bet on the future you perceive? If you bet heavily and you're right, you make a lot of money. You bet heavily and you're wrong, maybe you get carried out. As opposed to the person who does not have strongly held views, doesn't bet heavily, and never makes a lot of money and never gets carried out. Which of those do you want to be? I believe that I believe in luck, and I believe that, tied with what we discussed about Mujo 30 minutes ago, it's only harnessable to a minor extent, or predictable to a minor extent. And I don't think of anticipating the future as a source of profit. I don't have in my brain, I don't have a macro forecasting department, and I don't consider it a profit center. Some people do. Difference of opinion. But I think that luck is very real, that there's a big degree of unpredictability. Now, you talked about backgammon. Backgammon, for those who don't know, is a game based on the throw of dice. And you and I know that when we throw a pair of dice, the outcome is determined, absolutely determined, by a probability distribution. 7 is most likely, because there are 36 possible combinations of the throw of a dice, and 6 of those combinations will give you a 7. 1, 6, 6, 1, 5, 2, 2, 5, 4, 3, 3, 4. 6 of the 36 will give you a 7. That's 16.7% of the time. There are only 5 combinations that will give you a 6. 4, 2, 2, 4, 1, 5, 5, 1, 3, 3. And there are 5 combinations that will give you an 8. 5, 3, 3, 5, 6, 2, 2, 6, 4, 4. So you have 6 chances, or 16.7%, to get a 7. 5 chances to get a 6 or an 8, and that's that's like 14% or something like that. And then 5 and 9 are less likely, and 4 and 10 are even less likely than that, and ultimately the least likely are 2, because you have to get one possibility out of 36, 3%, or 12, which you have to get 6, 6. So we know 100% mathematically what the probability distribution is. But remember what Simpson said. More things can happen than will happen. There are 36 possible outcomes. We know their distribution of probability, but only one will happen. It's a sample of one. And if we throw the dice, one should not bet very heavily that a given number will come up. That's a pretty risky thing to do. So I think risk is a real thing. Luck is a real thing. And again, I think you have to accommodate to it. You have to be stoic. Yeah. And, you know, my friend Bruce, that I played with a lot, as you mentioned, by the way, that's not Bruce Karsh, my partner. It's a different Bruce, I think you know. But as he says, you know, look, you're in a situation in backgammon, and you're going to lose the game unless you throw 6-6. And you throw 6-6 and you win the game. It was still only a 3% possibility. Nobody would bet that you would have won, but you did. And so what Bruce says is that unlikely things happen and likely things fail to happen all the time, because more things can happen than will happen, and there's only one. It's a sample of one. And that's the way you have to think about life. And your life will be affected by luck. Mine has been affected by luck, and almost exclusively good luck. And I accept that, and I acknowledge it, and I revel in it, because I just feel so happy that I've been so lucky in my life. Other people might say, oh, damn it. You know, it's frustrating to me because, you know, I've been successful, but it was only luck, and it could have gone the other way, and I feel terrible, and how do I know my luck won't change? So it all depends on, you can look at it glass half full, glass half empty, and I look at it as very full.
No, I really like that. That's a very good way of looking at it. And I think a lot of our viewers are students, and luck is, again, a huge part of it. You know, you almost went to Lehman Brothers.
Yeah.
I'm sure you look back at that with very glass half full,
Yeah.
almost full.
Yeah. And you know, since you know the story, Arjen, I was turned down by Lehman Brothers. 30 years later, I happened to be in touch with the guy who was the recruiter for Lehman Brothers. He graduated from University of Chicago a year or two before me, and he was the recruiter. That's what people do. They send alumni back to campus to recruit. And he told me that the recruiters voted to hire me. And the man in charge came in, I think, hungover that morning, and called the number and offered the job to my roommate. Luck, right? And it could have had horrible ramifications for me, but it happened to have wonderful ones, because you know, you could have come out of grad school in '69, as I did, went to Lehman, became a senior partner, owned a lot of the firm, and have all your net worth disappear in 1968 when it went bankrupt. So I was very lucky not to get that job, as far as I know. Now, you never know, because I could have gotten that job, and it could have been a stepping stone to something bigger and better than I ended up with. I'm quite happy with the way I ended up, so I wouldn't hope for that. By the way, your students who are watching, maybe a more relevant reference would be to Back to the Future. I don't know if you've seen that movie. Even that movie is an old movie now, but it's about somebody invents a time machine, and you can go back to the past, and he goes back to the past, and he sees things that are happening, but he refrains from changing them, because changing the past could change the future, and he likes where he ended up in the future. And I think that's the intelligent way to think about these things. And you know, so maybe that was a piece of good luck or a piece of bad luck, but I don't think about it too much, because I'm so happy with how things ended up.
It's very nice to hear that you're very happy about it. I think the fact that you can look back at that and have a positive, spin on it is great. I mean, I think a lot of us who face rejection, maybe it's difficult to do it now, but again, hindsight is always 2020. So maybe 10 years down the
Well,
lane.
which is not to say it felt great at the time.
Of course, of course. I'm sure it stunk. You've compared investing at Oaktree to one of your favorite Italian restaurants, Il Gattopardo, which is right near the office, I believe. Always
Right.
good,
Yeah.
sometimes great, and never terrible.
Yeah.
Was it your partnership with Bruce Karsh that you think sort of created a discipline or a structure that sort of prevented you guys from ever getting into that never terrible territory?
Well, I can't say that it was I had, there were five of us who founded Oaktree.
Sure.
So I can't say that it was all Bruce.
Right.
I'm sure a lot of it came from me, and some of it might have come from the other five, and who knows what. But I think the point is, I wrote a memo. So you seem to have read a lot of memos. So I wrote one, I think in '02, called The Most Important Thing. Did you read that one?
Most important thing is many things.
Yes, it's many things. And of course, as you know, I used that title from my book, which I published in 11,
Yep.
Most Important Thing. And there are 21 chapters, and each one says the most important thing is, and then it's a different thing. Because in investing, there are so many things that are crucial. But when I wrote the memo in '02, taking the same approach, there were a bunch of sections, and I talked about the importance of a healthy work environment, and especially a good partnership. And that's what Bruce Karsh and I have been happy to experience since 1987. So 38 years and counting. And it's been one of the greatest things in my life. And I say that the key to a great relationship is shared values and complementary skills. So I think that Bruce and I and the other founders all shared the value of the importance of consistency as opposed to shooting for the stars. That's really the choice you have in investing. There's a trend line, and let's say that's the market trend line. Now, you can index and be sure of market performance, or you can indulge in what's called active management, and you can overweight some things and underweight others, and exclude some, and then you do that because you hope to do better than trend line, but of course it exposes you to the possibility of doing worse.
Yeah.
Well, maybe I should draw you a picture rather than use my own.
Mhm.
So here's the S&P over time.
Yeah.
And you can get that easily and cheaply by buying an index fund. But you say, no, I want to do better. So you make some active bets. You overweight this and you underweight that, and you don't own any AI stocks.
Right.
And you hope that it'll let you do that. But there's a possibility that it'll make you do that.
Yeah.
And I've described the error as symmetrical, which I think it largely is. Mm-hmm. But instead, if you want to, you can buy a portfolio with only one stock, mm-hmm, and try to do this and really shoot for the moon, but with the possibility of doing that. So you have to choose your approach. And this is maximization. And let's say this is a more consistent approach. You try for moderate victories at the expense of the possibility of moderate defeats. That's the way to think. And I think that Bruce and I, remember, Bruce joined me in 87. I had already been in the investment business for 19 years. So I had a more fully formed investment style or theory than he did. But we agreed that we would try to be a little better every year, consistently, and not shoot for the stars and never crap out. And if you have two people who diverge on that subject and they're trying to be partners and work together to achieve investment success, I think it'd be very difficult. And again, since you read the memos, I don't know if you ever read the first memo, the route to performance. And I talked in there about a client at a pension fund who had run that pension fund for 14 years. And in 14 years, the performance of their equities was never above the 27th percentile or below the 47th percentile. So they were solidly in the second quartile every year for 14 years in a row. So, well, where did they come out for the whole 14 years? You might say, let me think. They fluctuated between 27 and 47. So I would say on average, probably around 37, right? No, fourth percentile, very top. How can you do that? They've never had a year when they were even in the first quartile. So how for 14 years could they be in the top decile? And the answer is most people aim for the stars and eventually shoot themselves in the foot. And so Bruce and I took the approach, although our work together predated that memo and the dinner that inspired it. And it was always our approach that we were not going to take unlimited risk in pursuit of success, that we would limit the risk and try to be a little better at the expense of possibly being a little worse, but not shoot the works. And so that, but I mean, I don't see how you could do that or how you could work together on that subject if you didn't agree on it conceptually.
It's been very harmonious, clearly. And as you said, complementary.
It's been wonderful.
In interest of time, I'm going to keep it to one final question. This is one that I've been very keen to listen to. In your recent memo, Is It a Bubble? You have a postscript, and I found that postscript very interesting, almost a bit concerning, but you sort of discussed how AI is just more than a financial, I guess, phenomenon right now. In your perspective, it's something that influences whether we have a will to wake up in the morning, whether we have a reason to actually get up and go do work. So for students who are about to enter the workforce and who haven't experienced that sense of meaning yet by waking up every day, maybe in an internship, but not for decades long like you have, how do you sort of suggest we find our meaning before a world where technology and AI sort of seep so deep in that we might not ever find it?
Well, I think that the general prescription is unchanged, but I think the vagaries that AI introduces regarding the future make it harder to execute. But clearly, the only thing you can do is think about who you are, what you're good at, what you're not good at, what you like, what you don't like, and try to find a job that fits that. The only trouble is the nature of jobs is probably going to change a lot when AI gets thoroughly adopted, and so the impact is going to be hard to predict. But my advice to young people is always the same: try to find something that plays to your strengths, avoids your weaknesses, and that you'll enjoy. Go back to the beginning of this interview. Under something of value, we talked about readily available quantitative information about the present. That's not going to, and that's all over the memo. That's not going to be the success because everybody has that data, and AI will probably do a better job of marshaling and analyzing that data than you will. So you have to bring something to the party to succeed in a world where you have this powerful competitor called AI. And it has to be insight. It has to be seeing something that other people don't see. And so it's probably more important to incorporate first principles and a belief system, and of course have it turn out to be the right one. But AI is going to be better at pushing numbers than any human, and faster, and will not make any computational mistakes or emotional mistakes. And so try to figure out an area where you can contribute insight, where you, and it may be aesthetic, it may be physical, stamina, it may, any of a lot of things. But I think a starting point for a career decision may be, what can I do that a very smart machine can't do as well or better? Mm-hmm. Remember in the memo, I talked about electricians, plumbers, and masseurs. And I started getting notes from people saying that that there are machines that give massages. Now, I haven't had one. I think I like the human touch, but I should try one to find out. But I mean, so finding things that absolutely are not going to be impacted by AI seems very challenging these days. I guess being a great painter, a great musician, a great composer. These are some of the things where you're safe, but not many of us can do those things. Mm-hmm. But as I said in the memo, I'm worried about the implications of AI for the future on society, and I put that out 10 days ago, so I'm still not over it.
Well, I hope you make peace with it.
But I think that people have to have that conversation with themselves. What are they good at? What are they bad at? What do they like? What do they not like? What do they think will bring them enjoyment? And what can they do that a really smart machine can't do better?
I couldn't agree more. And I think that is a question that I'm certainly going to be asking myself a lot more of. And I hope that people watching this as well.
Well, you can make a career doing podcasts.
I mean, it's a great way to share the insights that you've had, and I think it's our goal is just to democratize your insights for students, everyone. So for you taking the time out, I'm very grateful. Thank you very much. I hope you enjoyed.
I did enjoy it, and I hope this served your purposes.
100%.
Great.
Well, thank you very much, Howard. I really appreciate your time.
My pleasure. Bye.